In English, because we are connected already and through the web, and so all the presentations and the discussion we have here will be streamlined, and so we are very happy to have you all here today and to brainstorm, because this is really a brainstorming high-level meeting on financing for development, with a special focus on infrastructure finance. We have a full program. Our guests will be leaving at 4:30, so we need to be concise and have the best use of the time possible. I would like to thank, first of all the speakers for being here with us today, to share their experiences and their views. I want to thank all of you for coming, and a special thanks to our students who are also here and who have joined us. I want also to thank some of the representatives from embassies in Greece, and I would like to invite you all to contribute to the discussion. This is actually a high-level meeting on this year's report called European Report on Development. This is an annual product of the European Commission on development and development cooperation. And this year's theme is financing for development and other means of implementation, and Dirk, Willem, Velde, the project leader, will explain to us what the other means of implementation mean. So it will be financing for development and other means of implementation in the post-2015 context. Why 2015? As you know, we had the Millennium Development Goals spanning the period 2000-2015. A new period is starting in 2015. Throughout the UN processes, there are discussions as to what the goals for the new agenda, the new development cooperation agenda, will be in the post-2015 era. These deliberations have not ended. We are in the process of these deliberations. But there is no doubt that there will be a financing agenda, which will probably be decided in a new conference, which will be in 2016, 2017, probably. We used to have, in 2002, the Monterey Conference, which was a very important global conference on financing for development. This will be the follow-up event in the years to come. So the Commission wanted to prepare and have a major input towards these deliberations, and this is what the European Report on Development is all about, with the special theme, financing for development and other means of implementation. Now, the audience is mainly Greek. Financing for development, allow me to say, is not only about developing countries. It's about all countries, developed and developing alike. There are different bottlenecks, different enables, depending on the country context. But I think that for our own country, in the midst of a severe crisis as the one, the issues and the subjects that will be touched upon today are as relevant as it is for some of the developing economies and emerging countries, developing countries and emerging economies. So we should start. First of all, I would like to give the floor to Professor Michalis Spourdalakis. He is replacing our rector, Professor Theodosis Pellegrinis, who unfortunately had an urgent meeting right now. So I would like to welcome Mr. Michalis Spourdalakis, Professor Michalis Spourdalakis. He is the Dean of the School of Social Sciences at the University of Athens. And the University of Athens is one of the core partners of the team of research institutes that are preparing this European Report on Development. The institute is ODI, the Overseas Development Institute, which is the lead organization. ECTBM, the European Center for Development and Public Management, out of policy management out of the Netherlands. DIE, the Development Institute, German Development Institute out of Germany, our own university, the University of Athens, and Southern Voices, which is a network of researchers and institutes from the South. So these are the 5 core partners who were asked to prepare this report, won the bid to prepare this report, and we're very happy to. This report will be presented towards the end of this year and will be published towards the end of the year. So we are in the midst of our discussions and preparation of the report, and this is one of the workshops, high-level meetings to debate and discuss ideas and get your own inputs into the report from your own experiences and knowledge. So, Professor Spourdalakis, the floor is yours. Yes, that's fine.
Good afternoon and welcome, ladies and gentlemen, dear colleagues, dear students. On the behalf of our rector, Professor Theodosis Pellegrinis, I would like to welcome you to this international meeting. And there are 2 reasons that I would like to, they are special to us, that this meeting is very important. The first has to do directly with our university, with our university system. This meeting proves that our university, another Greek university, despite the bad press, that responds to international challenges and participates in the current challenges regarding development and as a response to the crisis. And the other has to do with a new school which I represent here, the School of Economics and Politics. This new school, departments where the Department of Economics, Department of Political Science and Public Administration, Media, Communication, and Turkish and Asian Studies are part of this school. It's a new school which is, of course, represents almost the entirety of social sciences, aims to promote an interdisciplinary approach to current issues. And you don't need me to tell you that development is a very, very complex issue, and no single social or other science can approach it. Your endeavor here proves this interdisciplinary approach. I tend to tell, I often say to my students that we live in times where are very sad for the society, but they are fantastic for social scientists and researchers. And this initiative, I hope, that will prove not only and improve not only our understanding and our policies towards development, but also improve the collaboration of the various departments and various fields of the various disciplines in our school. With these thoughts, I would like to welcome you again and wish you a very good and fruitful meeting.
Thank you very much.
Thank you.
Thank you very much. Indeed, it's an interdisciplinary team spanning economics, political science, geography, public research, both here and also the research team that has been brought together under ODI in the consortium. Thank you very much. So the Minister Hatzidakis was not able to join us today because of some urgent meetings at the ministry. We have, as you know, the Greek presidency, and there are meetings which are taking place right now. So I will ask Mr. Nikos Mantzoufas, who is a special secretary of the ministry, to say a few words on behalf of the ministry.
Thank you very much, and I welcome you all to this very interesting session in one of the most important features within Europe and globally. How do we achieve growth and jobs? This is one of the most critical areas, not only for Greece, but for the whole Europe within the next years. And infrastructure investment, if well managed, I stress that, represents an important growth-enhancing form of expenditure. But how do we achieve, not only I say in Greece, but also in Europe and at global level within a tight fiscal climate? The top priorities should be to become effective and better use, to have an effective and better use of the limited resources we all have, and also to attract extra funding from private and international funders along with public finance. But both these targets need two fundamental things, in my view. Need good governance, and also they need to develop and implement an investment portfolio that encourages growth. Okay, easier said than done, but how do you achieve these basic targets so as to boost economy? In our view, there are some fundamental issues on how you should achieve these targets. First of all, to have an effective planning. This again is not obvious. Also to have a very sound project selection and coordination, and to have all the stakeholders involved. It's very often, not only in Greece, but in many other countries, I'm sure, that the selection process of projects is biased. You select the wrong projects, you claim that this will provide growth and jobs, but at the end of the day, this is not the reality. So all these approaches should be in line so as to get real value for money projects that produce growth and jobs in real terms. And saying that at the same time, there must be a whole life approach into this type of projects. Finally, in all this, you must have a very transparent and competitive procurement process. These are a few words that I wanted to pass on behalf of my minister, Mr. Hantzidakis, to welcome you all in this session. This is a very interesting topic. Later on, we shall provide a more detailed presentation in regards to how do we view all the things that I underlined in a more detailed way. So thank you very much for this event, and again, wish every success.
Thank you very much. I would like now to give the floor to Dr. Panos Karvounis. He is the head of the European Commission representation in Greece. The European Commission is our major partner in this endeavor, and we would like Mr. Karvounis to representing the Commission, to share with us his thoughts.
Thank you very much. Good afternoon, ladies and gentlemen. First, let me thank the University of Athens and the team in charge of the European Report on Development for organizing this important workshop. Let me in particular thank Professor Louka Katseli, who is one of the core members of the team leading this research, and who I suspect triggered the initiative of organizing this debate in Athens. Many thanks also to the University of Athens, to the Dean of the University. We are proud to see also Professor George Zanias, who is the President of the National Bank of Greece, the leading financial institution of this country, and also the support from the Ministry for Development and Competitiveness. I would like to convey to all of you the best wishes from my colleagues from Brussels who follow this project. They work in a service called EuropeAid. They are, of course, very disappointed they could not be with us today. Let me give, in short, some background on the European Report on Development. This initiative is supported by the European Commission and several EU member states. It aims at mobilizing independent research to feed the development debate, not only in the EU, but also at the global level. The European research the European Report on Development has proven to be a most valuable tool to strengthen the links between policy and research. There are three well-known think tanks in this area who cooperate in this exercise. Mrs. Katseli referred to the three of them, ODI, DIE, and ECDPM. They have been involved in several editions already, and this year we are delighted that the consortium has expanded to include the network of Southern Voice on Post-Millennium Development. For this edition, we have also on board the University of Athens, which we particularly welcome. 4 editions have already been published of this report, the latest of which focused on post-2015, Global Action for an Inclusive and Sustainable Future. This forthcoming European Report on Development 2014 follows naturally. After focusing on what, we turn now to the how, by looking at financing and other means of implementation in the post-2015 context. The post-2015 agenda is certainly one of the crucial topics for the international community at the moment, for the EU and beyond the EU. The sheer amount of debate and literature it has sparked attests to the importance we ascribe to agreeing on a vision and roadmap for the world we want beyond 2015. We are all engaged in a global conversation on an almost unprecedented scale, which is set to continue until September 2015 summit, where the agenda will be agreed and beyond. Indeed, the 2015 deadline presents us with the huge challenge of designing a new framework, but also with a huge opportunity. We have set the bar very high, as we are aiming to agree on a single, universal, overarching agenda which will enable us to tackle the interlinked challenges of poverty eradication and sustainable development together. Agreeing on such an agenda, including on goals and targets applicable to all countries, will be no small feat. But if we agree on the vision and objectives without having considered how to get there, we will not have fully fulfilled our mission. This is why the issue of financing and other means of implementation is so crucial. It's not only about mobilizing all resources, but also making the most effective use of them in order to effectively support transformative change. And the post-2015 agenda will need to be underpinned by a global partnership in which all actors will contribute their fair share to the achievement of the goals and be held mutually accountable. Yet this debate is more often hampered by ideological discourse, rooted in a divisive and increasingly obsolete North-South narrative, at the expense of constructive discussion. This is why research has such an important role to play. You can bring independent, evidence-based knowledge and recommendations and help us chart the way forward. The theme of the debate is at the core of a global debate. Infrastructure is crucial for a transformative agenda. Infrastructure helps economies to structurally transform themselves, lift people out of poverty by offering better services, whilst they move towards greener energy and infrastructure can also address climate change concerns. To conclude, we are confident that the European Report on Development will usefully inform our reflection on the way forward, hopefully across regions, and will provide a timely, informative, and valuable contribution to the global debate. Today's workshop brings together expertise from the EU and from the development sector, mixing policymakers and researchers, academics, and the finance and private sector. This is in itself a promising format, a first step for exploring innovative solutions and new paths. I wish to everybody a very constructive work and a very constructive debate. Thank you very much.
Thank you very much, Dr. Karvounis. Indeed, this is research-based policy analysis, and one of the themes that will come again and again in our discussion is how you can mobilize best, how can we best mobilize financial resources, and how can we expand the effective use of resources. And this is a recurrent theme of the report. Thank you so much. Well, I give the floor now for the opening remarks to our last speaker, Professor George Zanias. I have to say, Professor Zanias is now chairman of the National Bank of Greece. He is a development economist by origin and an economist afterwards, and has evolved, and now he is in the banking sector. So I don't know what that says about development economics, but it's a great pleasure to have George Zanias with us today.
Thank you very much, Louka. Dear friends.
Absolutely.
First, let me thank the organizers, and particularly Louka, for inviting me here today on this very important, I believe, subject. In her opening remarks, Louka reminded me of words that I used to use in the past when I was working on development, things like Millennium Development Goals or Monterey Conference, etc. As I have worked for them in, I think, more than 35 developing countries in the world. I think, I'm not sure if Alexander Saris, who is sitting here on the front, has done more than me, more developing, or Louka for that. But this is very, very important. Here we're talking, this event, this conference has to do with financing growth through financing demand, and more particularly through financing infrastructure. As you know, during the financial crisis, for various reasons, there was a very sudden demand drop, and there was a need, really, the response to that crisis was to reduce, to finance demand. And then we had the fiscal crisis, and then we're trying to reduce demand, and now we are somewhere that GDP dropped, and again we have to see what we do about this. I think we all agree that adequate infrastructure investment is a crucial pillar for sustainable growth. In particular, infrastructure development can contribute to growth in a number of ways. Thus, this can reduce transaction costs, increase the durability and efficiency of capital, and foster international trade and investment. Moreover, infrastructure projects also have very high social returns on investment. To give you an example of the importance of infrastructure development, in the case of Greece, and according to a National Bank of Greece study, Greece could benefit 5.1 billion euros annually, or 2.5% of GDP, mainly through the formation of cargo-related clusters around ports. And this is only an example, 2.5% of GDP annually. The demand for infrastructure investments over the coming years is enormous. According to OECD estimates, over $50 trillion of US dollars is required globally to finance the infrastructure needs of the next 15 years. In Europe, it is generally acknowledged that major investments are required in infrastructure due to historical investment cycles, with replacement now being a priority, but also due to climate change challenges, the lack of integrated electricity and gas networks, and the fragmentation of transportation networks. Estimates raise the EU economic infrastructure investment needs from 2.6% to 4.5% of GDP annually. I think the Commission gives 3%, which is in between. On the supply side of infrastructure finance, it is more than obvious that the economic and financial crisis have left a deep mark. Finance at longer maturities has become more difficult to obtain, whereas the need for fiscal consolidation in the EU limits the role of governments as a financier of infrastructure. In this context, the euro area infrastructure investments as a share of GDP dropped from 4.2% in 2008 to 3.5% in 2012. This drop in the crisis countries was from 5.5% down to 3% over the same period. At a time when fiscal policy remains tight, public money can only be part of the solution. Thus, we are seeing these days, and during the recent past, that the ownership as well as the finance of infrastructure assets being gradually transferred to the private sector. Government regulated but privately owned and privately financed infrastructure projects become more common, while specific institutional arrangements, mainly PPP, which is really what Mr. Mantzoufas is doing also, have been developed. With regard to the European banks, those are currently trying to repair their balance sheets, while the new Basel III rules are steering banks away, I would say, from long-term loans by making more tight the limits for long-term financing. Mm-hmm. On the positive side, however, there is increased activity in cooperation with international financial institutions and institutional investors. This bank intermediation process could move Europe towards stronger securitization and capital markets maturity. We at the National Bank of Greece are supporting infrastructure projects strongly and consistently. In fact, during the past 2 decades, we have contributed significant amounts for the completion of significant projects, such as the Eleftherios Venizelos Airport, the Rio Ontario Bridge, as well as the upgrade of the country's motorways. While more recently, past few weeks, we have supported significant PPP initiatives for building schools or waste management projects. It is obvious that greater involvement of private investors in infrastructure funding is needed. However, to unlock this potential, there are policy steps that must be taken in order to close planning, governance, selection, partnership, and communication gaps. Thus, I will name 3 steps. First, more transparency of investment risk is needed. Governments can act to restore investor confidence by providing greater transparency in structure as well as simplifying planning and procurement procedures. Second, regulatory risk needs to be reduced through keeping to a minimum, if not eliminate, unanticipated policy changes. And third, financial guarantees from governments to investors are needed in order to minimize risks, especially at the first critical stages of the project. In particular, expansion of public support through pan-European and national government guarantees will help to attract funds from non-bank investors. For example, the EIB's project bond initiative is in this direction. However, its funding capacity is currently small relative to potential demand for finance, and so it would benefit from an expansion. Dear friends, these practical steps will contribute to the creation of a suitable ecosystem at policy level, as well as an efficient managerial flow at project level. All agents involved should cooperate to achieve this goal, as infrastructure investment is a critical keystone for the economy to function efficiently, both for citizens and businesses. This is how much I want to say at the beginning, and I want all of you to thank you for listening to me, and I am sure you're going to have a very useful debate today on an excellent topic. Thank you very much.
Thank you very much for these very helpful comments, which we will pick up in the discussion on infrastructure. You already touched upon three of the main issues: transparency, regulation, and risk mitigation. And these are at the core of the discussions that we will have immediately after we hear first from Dr. Dirk Willem T. Velde, who is the leader of the project, and he will present the preliminary results of the whole project, and then we will have the chance to focus on one of the enablers, as we call it, which is infrastructure and infrastructure finance. So, Dirk Willem, the floor is yours. I might ask Professor Spourdalakis to actually give his seat, and maybe we can sit down, or you can stay here, it doesn't matter, because we can change immediately afterwards. Okay, whatever, but you might want to look at the PowerPoint. Exactly. So his presentation will be on aims, objectives, and emerging findings from the whole report. Let me say, till Dirk Willem is putting up his PowerPoint, that, as I said before, if the meeting is streamed live online, and we have questions that are coming up. So if Leah is in the back, if after Dirk Willem's presentation, if there are questions either from the live streaming or from the floor, we will have a small question and answer period, and then we will follow with the presentations. Dirk Willem. Absolutely.
Brilliant. Well, good afternoon, and thank you all for being here, and thank you, Louka, for hosting this meeting, and thank you to the University of Athens. We're extremely grateful to be in partnership with the University of Athens and with a number of other institutions that have already been mentioned to prepare this version of the European Report on Development 2014, which is called Financing and Other Means of Implementation in the Post-2015 Context. I wished I could say some words in Greek, but despite my 6 years of education in Greek, we only taught to read, not to speak, because it was the Greek that happened 2,000 years ago. So I can't speak in Greek, but let me then move on to discuss this in English. But it is a multicultural team consisting of a number of experts from a range of European and non-European countries that is preparing this report. As we've heard, it is an annual report, and this is the 5th version. We've had 4 before, and this version will be launched in December 2014. So we're some way away. And therefore we can talk perhaps more about aims and objectives rather than results. We don't get there yet. We'll come through a range of consultations, including we will have a number in Brussels, but we've already had a number of other consultations in developing countries. We're engaged in this process. We have consultations in developing countries. We're drafting a range of reports as part of this endeavor. We've got the main report, which is going to be a substantive report, and we have a team drafting this. There are 5 core team members, but behind that there's actually a team of about 25 researchers from the various research institutions preparing this report, which consists of around 10 chapters. In the process, we're also commissioning a range of background papers, and there are one or two authors of the commissioned background papers in the audience. And these papers will help us to improve the relevance and the academic quality of the report. And we've also engaged in commissioning a range of background studies, country illustrations, as we call them. And there are country teams in place in 6 countries, drawing on the network of Southern Voice and beyond, to provide illustrations on the importance of finance for a post-2015 agenda. Now, the target group of this report is in part, of course, EU development officials. So from the Commission and from the Member States, we do this directly for them. It's an independent report, but it also goes beyond, as the EU representative already mentioned. And in particular for this report, we're very interested to influence the process on financing for development, and a number of other processes, and I'll talk about that in a minute. Now, the main research question behind this report is how can financial resources be most effectively mobilized and channeled, and how can it be combined with selected non-financial means of implementation to effectively support a transformative post-2015 agenda. And in the presentation, I'll highlight these issues that are in bold. So financial resources, we mean public and private resources, international and domestic. So international public is aid, domestic public could be the resources that you gain from taxes, international public investment, foreign direct investment, but there's also, of course, domestic finance. When you think about finance and when it can tries to achieve objectives, it doesn't do that in isolation. It does it into a context in which other policies matter. And that's where the non-financial means of implementation come in. We've also talked about effectively supporting a transformative agenda, which is, and I'll explain that in a minute as well. Let's go back first and say, where do we come from? Because we've gone through this issue about financing for development already at least once in an international setting, in UN setting. So first of all, we were thinking about the Millennium Development Goals, the Millennium Declaration from 2000, and it was highlighting a number of Millennium Development Goals, 8 of them, and it highlighted issues like halving poverty from 1990 to 2015, and a number of other goals related to health, education, and it has some other goals on partnerships. When the goals were set, after that, 2 years later, there was the Monterey Conference in 2002 discussing how these goals could be financed. So it had a range of chapters on different financial flows. And after that followed the discussion on implementation of this. And there were a range of finance needs studies that came into play. So Jeffrey Sachs at the UN was quite instrumental in this. The World Bank had a number of needs studies. And in these studies, it highlighted how much resources were needed to achieve a goal. So it was a finance gap that had to be addressed. And in that context, it was often the case that aid was seen to be the gap filler for filling gaps in the poorest countries. These studies have been used probably quite successfully in order to mobilize more aid at that stage, so 10, 15 years ago. In 2002, aid was 50 billion a year. Now it is about 130 billion a year. And it went particularly to the social sectors, and that's where the MDGs, the Millennium Development Goals, were particularly focused on the social sectors. So in that sense, you can talk about that this financing for development framework and the attention that it focused had some results on particularly on aid resources. So these were the type of studies. So you had minimum and maximum to reach MDD 1, MDD 2. MDD 1 is poverty, halving poverty goal. MDD 2 and MD 4, 5, 6 is about health and education. So these is in terms of billions, quite large numbers. Just by comparison, I've also put infrastructure on there. That wasn't necessarily a part of the agenda at that stage, 15 years ago. It was more the social agenda, and infrastructure wasn't looked at. But when you talk about infrastructure, we talk about a complete different ballgame here. It's in an area of trillions rather than hundreds of billions for developing countries. So this was the model that was often discussed. It said, well, we've got aid can help to achieve the Millennium Development Goals. Now we're in a new context, and we'll talk about this in more detail. We first talk about a transformative agenda, and this includes a range of goals that are being under discussion. We are not taking on the difficult task of coming up with the new goals. That's being under discussion under the Open Working Group at the UN, and it has about 16 or 17 areas at the moment. We've been thinking about how we can describe some of the underlying issues here, thinking about an economic, social, and environmental dimension of the sustainable development transformation that we're all looking for. So think through an economic transformation where you allocate labor towards high productivity activities whilst creating employment. Think about a social transformation, the second bullet point, where we want to go to zero poverty, not just halving poverty, but actually zero poverty whilst reducing inequalities. And think about the environmental transformation, where we want to be thinking about how developing countries can particularly get access to energy, whilst also reducing carbon dioxide emissions, so that we can stay within limits in terms of temperature rises, and preserving biodiversity. So this is a very complex agenda that involves more than we had before. It involves also economic and environmental issues up front. So we also need to think about the role of finance in this, and this is the topic, of course, of our report. And it's a complex agenda, but the role of finance is also more complex. So before we had maybe this model, we now talk more about this model, where finance flows do not go directly to the goals. They go through the enablers, including an infrastructure. And we'll talk about infrastructure. Infrastructure is an important enabler that can help to produce economic transformations, social transformation, and environmental transformations, as we'll talk on that after this discussion. We're not talking only about aid, so we're talking about a range of financial flows, the top box. It's public and private, domestic and international. Although the Monterey discussion already included domestic resources and a range of financial resources, the implementation of that 10, 15 years ago didn't highlight that as much. Now we can't get around the fact that that other financial flows have grown in importance and play an important, are likely to play a very, very important role into the future as well. Now, the finance flows can then put the enablers in place, and we've got as deep enablers quality of institutions. We've got factors of production like capital, i.e. Infrastructure, labor, and technology. And we also talk about connectivity and integration as an important driver of the sustainable development transformations. Finance can help to put this infrastructure in place, and this finance needs to be mobilized. So that's the arrow on the right. What are the policies needed to mobilize this finance? And then it needs to be implemented effectively. And we already had the discussion a little bit about these three areas that you mentioned, Louka, about what are the complementary factors that will help an effective implementation of financial flows for infrastructure. So it's a complex picture. Now, what are some emerging issues that we come across whilst researching some of the data and some of the country illustrations so far? First of all, it's complex and messy. It isn't straight, linear, easy. Nonetheless, we try to get some structure in it for ourselves, for methodological reasons, but in reality, of course, it's a complex and messy situation of how transformations come into play and what the role of finance is. All the country illustrations so far, and also discussions that we've had on looking at the role of tax revenues, the role of aid, suggests that public finance is important, particularly at lower levels of income, and it's likely to remain important. But of course, its role might be evolving over time, but also as countries move up the development level. We are seeing an important role for ODA, particularly in low-income countries, so aid. But increasingly, as countries become develop, it is not in the sense of delivery as such, delivering areas, but it's in supportive and this catalytic role. It can help to leverage in other flows. Think about a development finance institution. Think about European Investment Bank. Think about these issues, how aid can be used to be combined with EIB loans in order to then leverage in other private finance. So it's a supportive role. What we also have a discussion on is it's not just aid, it's also beyond aid that is important, and in particular private finance. As countries move up the development scale, the private finance flows become important. It's banking credit, but it's also pension funds that become important, and these other areas. And different financial instruments become important as well. Think about PPPs. The evidence so far suggests that in countries like Bangladesh they didn't work, still in the least developed country. In other countries, middle-income countries, there they might work a bit better. And beyond finance is an important issue that comes up. While we talk about finance for development, it's not just finance that matters, it's the context that matters as well, the other non-financial means of implementation. So, to highlight these issues, we've got a bit of a couple of charts on this. This shows you the flows going into countries as a percent of GDP. So you've got 30% of GDP as a top there, to 0. At levels of income. If you are at 7, you're at 1,000 GDP per capita. Then you move from a low-income country to a middle-income country. If you're at 8, you're at about $3,000 per capita. You move from a lower middle-income country to an upper middle-income country. As countries become richer, the percentage of aid as per GDP declines. So that's the top line. What we see at the same time happening is that domestic resource mobilization, particularly in the area of tax revenues, so tax to GDP ratios, they go up. So they're quite low initially, 10% of GDP. They go up as countries become richer. Remittances also, there's a bit of a hump shape, but they go up as well and become more important than ODA. And foreign direct investment also becomes more important over time. So there's a range, and this is very average. So this groups all countries together, and we have a range of charts in the report so far in the draft sections that basically say other resources become very important for different groups. For lower middle income countries, upper middle income countries, domestic resources like tax revenues become very important financing sources for development, although for low-income countries, aid is still important. Now, I also mentioned beyond finance, and I just want to give you 2 examples. We've mentioned that private finance is also important, and here we can talk about one aspect of this, which is banking credit. So the access to banking credit is an important way to finance investment in developing countries. And in other developed countries. This access to credit, it can be expressed as a percent of GDP. It might be for low-income countries, it might be 20-30%, when for middle-income countries, for high-income countries, it could be like 100% of GDP. And in some countries, there's too much banking credit. We've had the financial crisis, we had too much credit, as it were. But in low-income countries, there's very little of it. But it's not just the access of finance that is important here. It's all, so the availability. It's also the terms under which you can access it and the cost at which is it available. Now, it might become obvious, but or it might be obvious for many. But if you look at the cost of accessing finance, and particularly for long-term needs, in the case of infrastructure or for SMEs, that's very difficult for particularly developing countries. They don't have very little access to the banking system, but even when they have access, they have to pay a very high cost. Now, some of the reasons are very obvious. So the interest rate that the commercial banks need to pay the national bank, of course, is higher for various macroeconomic reasons. But then there's an interest rate spread on top of that. an interest rate spread, non-performing loans, but it also reflects efficiencies of the banking system. And in African countries, the efficiencies of the banking system is much lower than it is in other regions. And of course there are differences amongst countries. But basically what it tells us is that it's not just that availability of finance is important, but also the cost under which it's available. And that is being driven by the efficiency of the banks in part. And if there were policies in place that help banks to innovate, to serve their customers better, to provide it to long-term needs, but in a competitive environment, the interest rate spread might come down, the cost of accessing finance might be important. So this tells us that the context also matters. It's not just the availability of finance, it's also the context in which it is available. A second issue, and this is the previous one was just the domestic context that matters. The second issue is more about the global agenda, where a global context also matters. And here this is an example for climate finance, to finance sustainable energy, for instance. Because we're not talking only about social and economic goals, but also about environmental goals. And here the needs are huge. So this is for developing countries, and the bars are, so on the left-hand side, these are investments that are already going into energy finance. We'll hear more on that later on. But then if we also want to be consistent with the 2 degrees warming, we need to green infrastructure. We need much more climate finance, and the need to go up dramatically. So this means we need to mobilize a lot of finance for green energy, and there are a range of issues that are important for mobilizing this finance. And how do you mobilize this finance? So what are the factors that are important for mobilizing finance? And that is where the arrow on the right-hand side becomes important. What are the factors that help to mobilize finance? Well, there are a range of factors, but I just wanted to highlight one here, which is the global mitigation regime. So if there's no price on carbon, if there are distortions in the way energy is priced, so fossil fuels are priced without taking into account the externalities, the damages that it has on the environment, there isn't much finance that is going into green finance. It's hampered, so it's not at a level playing field. If, however, you can incorporate the externalities into the price into a price of carbon through a global mitigation scenario, you will get a higher you will get a price for carbon. You get a higher price of carbon, and that will help to mobilize more investment in green finance. So this is just where a global setting might help you to mobilize more finance for green energy. Now, and I'll conclude with these 2 slides. We talked a bit about emerging issues that are coming up. We talked about some of the issues that we said, well, public finance is important, but it's also beyond aid that is important. And we talked. We had a range of workshops, and we were also in the case of Tanzania, we had a workshop, and here we were talking about the need for investment in hydropower, because that helps energy transformation. It helps also economic needs, and here the discussion was very much about how do we mobilize private finance. Of course, aid can help, feasibility studies help. But it's not. It's just part of the story, and they talked about different types of finance, how to mobilize South-South flows. The Chinese were involved in Tanzania, so it was a range of finance issues that are important. It's now more complex. It's not just aid; it is different finance flows that is important. At the same workshop, we also talked about beyond finance, and also said, well, there are all these wonderful ideas that the private sector has to invest, but actually there were a number of supportive regulatory policies that needed to be in place in order to make this investment in renewable energy happen. So they talked quite a lot about governance. And we talked about, in another workshop in the case of Mauritius, about the importance of finance to see it in a transformative context. transformative context, so Mauritius is now a middle-income country, but it wants to become a high-income country. So transformation and the transformative agenda that we talk about, it's a universal agenda. It also applies to Greece. It applies to many countries. It also applies to Mauritius. But what we've learned there from how they moved up the scale, they moved from sugar sector into garments, into tourism, into international financial centers, by building a consensus around where they need to go. And they had this settlement and said, well, we need to go in these areas. And they then identified the winners and losers, and they then made sure that the losers were compensated. And aid played a role in that to help to compensate the losers. And that's why you can see that aid might provide a transformative or a supporting role for transformations. Right. That brings me to the sort of the concluding issues. So ultimately, what we're interested in is to think through a finance for development framework to support a post-2015 agenda. This agenda is being discussed. What is the post-2015 agenda is being discussed. But at the same time, we're now also discussing the financing already. So previously, in Monterrey, was done after the goals have been agreed. Now, we do it at the same time. That is actually quite useful, and we have it in, it's likely to take place next year, although it's also part of the discussions. So at the moment we've got emerging issues and that come up, but of course we will have a much better storyline as and when the conclusions are there. It's more complex now than the implementation of Monterrey suggested. We have different finance sources that we need to discuss. We need to talk about private finance, we need to talk about blending loans and grants. We also need to now think about that finance is on its own is not enough, and think about new rules for different types of finance. So the question is, how do we signal this then into a new financing for development framework? And maybe you can help us with that. And maybe some of the discussions we have in the afternoon, later on in the afternoon about infrastructure, is we can then think about what are the important ways to mobilize finance to use it effectively. And if we then can learn from that, maybe we can take those elements and put them in a new framework and say, well, these are the issues that we want to signal to the world as a whole, and say, well, these are the factors that are important. And you mentioned 3 of those, maybe they can come back. All right.
Okay. Thank you very much, Dirk, Willem. Thank you so much. Before I open the floor, if you can go back to the enablers graph, I would like to carry over to the discussion on infrastructure 5 key points that Dirk Willem mentioned. First, that what we're interested in is a transformative agenda, a sustainable transformative agenda. And I think the point that we should keep is that there is no notion of sustainability unless it has an economic dimension, a productivity enhancing dimension, a social dimension, which is a poverty reduction, and an environmental sustainability component. So economic, social, and environmental go together to make it sustainable. That's number 1. Number 2, that to reach that, rather than go from financial flows to the goals themselves, to the transformations, you need now to work through what we call enablers. And what might be these enablers? Based on the literature and what we know, we have focused at 3 kinds of enablers. One is the quality of institutions. The second is what we call in economics the factors of production: capital, labor, land, technology. And the third one is networks, connectivity, integration of markets, and integration of both backward and forward. So networks matter. So the question then is, how does finance impact on these enablers? And infrastructure is one enabler. Point number 3, looking at finance, the new world will be beyond aid. Aid matters, it's important, will continue to be important, but the use of other sources of finance are extremely important. So third message is beyond aid. The fourth message are the two blocks to the right and to the left, that policies matter as much as finance, that you can see a lot of resources being lost and not effectively used, if not in the appropriate policy context. And policies is not only national policies, but also international policies. For example, if you have tax evasion and tax havens, you might do a lot of things for domestic resource mobilization, but a lot, you can have capital flight, tax evasion, and you lose resources. So the effective use of resources and the effective mobilization of resources depends on policies at the local, national, and international levels. So context matters. And the fifth point is, which is the open question that we will address now with infrastructure, is what combination, therefore, of finance and non-finance supporting policies can produce the best results for unleashing the potential of the enabler to promote the transformative agenda. So in the report, we look at almost all enablers, but for this session, immediately after the question and answer period, we will look at one of the enablers to give you an example and a feel of how we combine these, which is infrastructure. So it's infrastructure would be one of the enablers for a transformative agenda. So let's have, the session is supposed to go up to, we have 5-10 minutes. So if there are questions on the presentation and the framework before we go to infrastructure. Yes, Plutarch. Mr. Sakelaris, thank you.
It's a microphone. It's coming there.
I would ask you also to, rather than me doing the introduction, for each one of you to introduce yourself as you are asking.
Thank you, Louka. Plutarchos Sakelaris, professor at Athens, University of Economics and Business. It's not so much a question as I'm trying to give a little bit of an answer to your question on whether what is the optimal mix between financing and specific policies. And I can tell you that many times those two have to come either together, or if you don't have the specific policies, you're never going to get the finance. And I can give you an example from my experience in EIB, that one of our most successful countries of financing had been traditionally, in terms of PPPs and concessions, Cape Verde. In Cape Verde, which is a tiny economy, we had an amazing portfolio, very big and so on. And why was that? It was because this particular government was very forward-looking in terms of attracting private finance, and had developed the right framework for concessions. So once they developed the right framework for concessions, then you started seeing all the infrastructure capital, mainly in the form of equities and SPVs and so on, being able and being willing to come in. And then after that, of course, you had all the financiers who were willing to provide the long-term financing for that. So many times you have to have the specific policies before the financing can come for infrastructure.
Absolutely. That's exactly the point, that policies matter for the mobilization of finance. Yes.
Yes, my name is Potamianos, Mikes Potamianos, and based on my experience working sometime for the European Commission, I would like to ask a question being focused on the field of climate change. Because as we all know, climate change is very high on the priorities of the European Commission. Also in the field of development cooperation, where I suppose your field of interest focuses. We all know that being so high in the priorities of the European Union, some very effective mechanisms and instruments are being made available. And I refer to the joint implementation and the CDI, the CDM, the Clean Development Mechanism. I would like to know if you have at your disposal some answers or some examples of the effectiveness or efficiency of the implementation of that kind of policy in developing countries, given the fact that given the established Commission's policy provides the appropriate and necessary framework for implementation of policies and mobilization of resources. We do also know that the main financing instruments, official instruments in the European Union, are making funds available. So I would like to know what the effectiveness is concerning the mobilization of private sector funding. Thank you.
Thank you very much. Any other question, comment? Okay. Yes.
Thanks. I mean, I suppose both questions are in part about mobilization of finance, and so that's our part of our research question. So we've got a research question of how can you make it effective and how can you mobilize resources. The question of mobilizing resources is very important because we see that there are huge needs out there. And for infrastructure, we'll see probably some pictures later on that it's absolutely huge, it's in the trillions. At the same time, we also see that there's lots of money spinning around everywhere. And you talked about tax havens, you talked about institutional investors. There's lots of money there, but it doesn't necessarily go to the right areas that we want to go. It doesn't go to the long-term needs that we want to go to. But the good news is that countries can do something about that. They can actually help to attract that finance, or the Commission and others. You can also try to push, as it were, finance into particular areas. So there's a question about pulling and pushing of finance. In terms of the pulling, is the Cape Verde example. In part, is that if you have the regulatory frameworks, right? If you have developed your projects. If you've done the project preparation well, you've built a consensus about where you want to go in your economy. You know which project you need, and they're well defined. Then it's likely that you will be able to mobilize resources for it if it's well defined and if there's rates of return are well defined. So in that sense, governance, particularly specific around that project, will be very important in order to attract. To attract that investment. So that's on the pooling side. Now there are also issues where you can push finance. So that's the part that is the blending mechanisms, or it's that the European Commission has put in place. But it's also it's relevant for the range of development finance institutions. So development finance institutions, IFC, it's the FMO, it's the CDC, it's the EIB, and these have shareholders, and the shareholders and they're backed by shareholders. So the EIB has put in place blending schemes which are backed also by grants from the European Development Fund in order to blend grants with loans. So you've got grants from the European Development Fund that try to leverage in loans from the European Investment Bank, from the KfW, from AFD in France. Now the question then is and it can be used for climate finance because it can be used for hydropower to finance hydropower or so. The question is then how successful has this been? And I think we've begun to be at the start of this discussion because some of these blending schemes they started in 2007, the EU Africa Infrastructure Trust Fund, for instance. So it's quite difficult to think about the effectiveness. But what you can see is that so at some point in time we looked at that. 1 unit of grants leveraged in 6 units of loans, which coincided with about 20 units of private finance. So you've got those leverage ratios. Now there's still a question about what was cause and effect. Now you can have stories that in some cases, in order to get a hydropower plant financed, you need to lead to financial closure. The fact that you were able to use grants to do impact assessments, the fact that you were able to include the European Investment Bank or the IFC that had this stamp of approval, that led to financial closure, i.e. that led to mobilization of finance. So there are examples of that where it has been effective. But I think overall we are. This is one of the areas that we are looking into, and we think that the evidence so far suggests that at least we can be slightly positive on these new schemes, these new instruments. But we need to have a slightly more detailed look. But it's part of the transformation agenda. It's not just only social sectors, although that's still very important, but it's about economic, environmental transformation. This is project finance, and it requires development finance institutions and other finance.
Peter, would you like maybe to say something about the clean development mechanism in particular, or you want to?
Can you understand me without the mic?
For online.
Okay. Peter Wolf from German Development Institute. We'll talk on infrastructure later, but I think just one sentence to this CDM issue, the question about joint implementation and CDM. I think it's the same argument that we have heard before. When the policies are in place in the countries and institutions are in place, then it's much easier to use these international mechanisms, funding sources. And when you look at which countries are using them most, it's first China, and then long time no other country, and then maybe India, some other countries. So countries which have in place policies and institutions who are able to put the domestic framework in place, then you can. It's much easier to use these international funds. So we come to the same relation again with the means of implementation and finance. They have to go together. Thank you.
So in Sub-Saharan Africa, it has been used less so far.
Exactly. Okay, I think we are right on time. I think we can move. I will ask our speakers for the infrastructure financing to come and join us here and take their floor. Peter, Nikos Mantzoufas, Plutarchos Sakelaris, Spiros Pangratis, and Vicky Kefalas.
What is our timeline? Oh, that's great. 1 hour.
Well, like you have a combination of speakers coming from the research community, from the private sector, from the public sector, and we are very fortunate to have all these inputs into our discussion on infrastructure finance in line with the overall framework that we have. So we will start with Peter Wolf from the German Development Institute, who will give the initial results or questions or answers that we have given in the report, and then we will get the inputs and suggestions from everybody else in the panel. Peter.
Yeah, thank you very much, Louka. My name is Peter Wolf, German Development Institute, part of the ERD core team. And also from my side, I'm very grateful. Thank you very much for giving us the opportunity to reflect on our work, on our research. We still have more questions than answers, but we still have a couple of months to go with the report. And this gives us the opportunity, consultations, events like this, to discuss the issues that we are working on. Infrastructure, I don't need to explain again why this is important for the post-2015 agenda, and why it is important for the post-2015 finance agenda. It has been mentioned already, what I want to do now is that I want to explain a little bit why infrastructure is also important as an agenda for global cooperation. I mean, it's a national agenda in each country, but I would suggest that there are global coordination failures which we still have to overcome to set the stage also on a global level for countries, for developing countries, but not only for developing countries, to improve infrastructure investment. And I focus mainly on two kinds of investors: the development banks, DFIs, development finance institutions. They have been mentioned by Dirk, Willem, the CDCs, IFCs, FMOs, as well as institutional investors, because these are the sources of patient capital. And for infrastructure, we need patient capital which is staying on in projects or in investments, while commercial banks are not typical investors for infrastructure. And in both areas, development banks and in the area of institutional investment, there are still a lot of obstacles to overcome to improve the situation. It has been mentioned already, and I can be very brief on this, why infrastructure is so important. It's not only important for growth, economic transformation, where it can alleviate a number of growth constraints. It's also important for social transformation. Access to water, for access to sanitation, for energy is crucial for poverty reduction in developing countries, particularly in those countries where access to those basic services is still very low. We have learned in Tanzania access to energy is just 20% of the population who have access to energy. And if you can increase access to energy as well as to water sanitation, you have immediate results on poverty reduction. Environmental transformation from high to low carbon energy. If we still want to work in the 2+2% 2-degree world, the investment needs are huge, not only in developing countries, but also, of course, in developed countries. Dirk, Willem has talked already about the needs assessments. Here, just a couple of data on needs assessments that we are also using in the report, and we can see that the needs, of course, are different in different areas, and there are also definitely different kinds of different sources of finance that you would use for the infrastructure, different infrastructure sectors. So you have the mobile phone, the telecommunication here in this in one of the graphs, and of course this is prone to private finance, and this has happened already in the past couple of years. So it has already been also been mentioned by Dirk, Willem, the finance gap. There are different results from different studies how you define how you calculate the finance gap, depending on definitions and on assumptions. But for infrastructure in developing countries, it is estimated roughly that what is needed annually is about 1.5 trillion annually, and what is, I think, what we have to take into account, and as you have heard, this is one of the core issues that we are working on in this study, is that there is no financing need per se. Finance the volume of finance that you need for a specific purpose always depends on the policy framework, depends on the effectiveness of enablers, of means of implementation. It depends on a lot of things. And in infrastructure, and there is this new McKinsey study, it is quite obvious that you can save a lot in terms of investment needs, of capital needs, if certain conditions are in place, if the roles and priorities of governments are clear, if you have instruments in place to streamline the delivery of public services, of infrastructure, if you can improve operations, particularly maintenance of infrastructure, your capital cost will be lower than if you are not able to do that. If you can benchmark your construction and operational costs, it's amazing how different construction costs for the same thing are in different countries. It's amazing, and it's, of course, you have to look into why is that. So working with benchmarks in infrastructure, with benchmarking, is very helpful. If someone has to explain why construction of a road would cost double in this country than in the neighboring country, what are the reasons for that? And the discussion on this can help you to find a better solution, better solutions, more effective solutions. The question of brownfield versus greenfield investments. Greenfield investments, new investments, versus having old investments which you can renovate and upgrade. In most political frameworks, there is a clear priority for greenfield investments. Also, sometimes because finance is available, because sometimes even development banks, they prefer to build something new than to look at the existing infrastructure and upgrade it. But in many cases, upgrade of existing infrastructure is cheaper in the end, is more effective than having greenfield investments. So it really depends on the policy framework, on institutional capacities, how much capital you need. And you can save a lot by having these conditions in place. Now, what are the major challenges? It's, I think, nothing new to say that we need for infrastructure high upfront capital requirements, and it means investments in fixed assets under uncertainty. And this uncertainty usually is shying away private capital, private investors, and particularly the complex risk profile of infrastructure investments, macroeconomic risk, growth rate, inflation, political risks, how will the tariff policy for energy, for water, and so on develop, technical risks, particularly when it comes to new technologies, renewable energy. There are construction risks. I have to mention, because we have such a very bad example in Germany right now, the Berlin airport. It was calculated with 2 billion of cost. Now we are at 5 billion, 3 years delay. We don't know when it can open. So there, all the risks are in there, and it's a wonderful example. You have the revenue risks. You don't know how much revenue you would get in the long run. So it's difficult to calculate the cash flow. So if you want to have private investment, private capital in those investments, they will have high return expectations because they calculate all the risk factors in their capital, in their return and capital cost calculation. And then, of course, when it comes to basic services, there is the question of affordability. Will the water tariffs in a privately financed water company be affordable for the customers or not? This is obvious and debated in many situations, not only in developing countries. On the other hand, if the public sector invests, usually you have high contingent liabilities. in your, I mean, you can't see them in the budget, but you feel them in the budget later on and nobody is calculating them. You just calculate the capital costs and then the airport, the harbor, whatever is there, the cost, the maintenance, whatever, and all the costs connected to the risks which the private investor would calculate in his return estimates, income estimates are not calculated by the public sector. So you just leave it as a risk to the public sector. And this is the dilemma that we have in many cases. Would you be ready to pay a higher price for private capital, private investment, or would you rather take the contingent liability for the public budgets and be quiet about the risks? Now, I have said I want to focus a little bit on the international and on the global coordination with regard to infrastructure. And why did the G20 take up the infrastructure issue after the financial crisis? I mean, you can say they have more important things to do, and they were quite important in 2008, 2009 in calming down the financial crisis. But it was quite obvious that after the financial crisis, we will run into a period, and it was mentioned in the keynote speech, where long-term investment, particularly investment in the public arena, in long-term public investment, will decline. And we have heard the figures in the keynote from 5% to 3%. And I mean, it's in many developing, but particularly also advanced countries which were affected by the financial crisis, we have a slowdown of long-term investment, private and public investment. And the G20 took up this issue first as a development issue under the Korean presidency. Seoul Multi-Year Action Plan was more a kind of a development plan for developing countries. But then, and the report of this working group was presented by the high-level panel on infrastructure investment under the French presidency. Then under the Mexican presidency, again, there was an emphasis on engaging the private sector in infrastructure investment. You can read all this in the summit communiques of the G20. Russian presidency, again, they have now established a working group, another working group on long-term investment. And now the Australian Prime Minister under Australian presidency, now he said in one of the first speeches under his presidency, now we want, with regard to infrastructure, move beyond the rhetoric and deliver tangible outcomes. So what is expected from the G20 is that they will mobilize the development banks, World Bank, multilateral development banks, World Bank, IFC, and regional development banks for infrastructure investment, and they will also work on the framework conditions for institutional investors for infrastructure investment. So this is what we can expect as an outcome from the G20 under the next 2 or 3 presidencies, tangible action in this area. So what was just some recommendations from this high-level panel on infrastructure investment. What they say, what are the core issues? First, ensuring a strong and sustainable supply of bankable projects. The constraint is less one of funding than an insufficient pipeline of bankable projects. So that's what the bankers always say. We just don't have the bankable projects. It's not a new issue, but it's reiterated again by this high-level panel, which was a mix of private and public figures who did this report. Contributing to building an enabling environment. The private sector will not invest in the dark. When the enabling environment policy framework is there, then the private sector will move. Making funding available under appropriate terms. And here we come to all sources of finance which are important for infrastructure, particularly the local currency debt markets, which are more appropriate for infrastructure finance in most cases than external debt, because you don't have the currency mismatch, the currency risk involved. Local financial intermediaries are important. The multilateral development banks, their task is to crowd in private capital through the use of risk mitigation instruments. co-financing by institutional investors, sovereign wealth funds. So all the funding, as has been mentioned by Dirk Willem before, the funds are there. I mean, in institutional investors, they are sitting on 70 trillion US dollars in funds. In principle, the funds are there, but they have to be mobilized. And one way of doing this is working with the multilateral development banks to identify a set of exemplary projects, because one of the bottlenecks is that we don't have a lot of good practice, exemplary projects, particularly with public and private, in combination of public-private, PPPs or any other combinations of public and private funding. So what they have tried to do now is to have this kind of list of exemplary projects, particularly regional projects, cross-country projects that they want to work on. We also had an infrastructure action plan of the multilateral development banks, also as a work under the G20 umbrella, and they came to similar conclusions. Improve project preparation funds, again the pipeline of bankable projects. Develop catalytic regional projects, expand technical assistance, increase incentives for bank staff to engage in PPP transactions. In a multilateral development bank, it's different in the EIB maybe, but in the World Bank and others, there are no real incentives for staff to engage in public-private funding, because they like the big projects where they can disperse big chunk of funding from the Asian Development Bank or the World Bank, instead of having just a small part of public funding and a big part of private funding. The incentives are just not like this, that they would get a positive marks for that. And some other initiatives which are now ongoing with the multilateral development banks. Now, as we can see, in the past couple of years, infrastructure funding through official development assistance and multilateral development banks has risen. I mean, since 2004, 2005, we can see that there has been a rise in funding of infrastructure through the banks, but in the end, it's not, I mean, you see it's 70, 80, 90 billion. It's compared with the huge figures that we see from the needs assessments, it's still not very much. We also see in the graph below that private participation has been on the increase in the past couple of years, but this includes also, for example, telecom. I mean, we have seen the mobile phone complex. If you take it out, the private part, the portion of private participation is not that big. You find not much of private participation in water, sanitation, transport. There the ratios are quite small. Now, I come to my last 3 slides. I think, and this we also can see from the reports under the G20, the capacity of development banks and development finance institutions is still underutilized. We could do much more through development banks, through the public banks with the patient capital. The commercial banks, they face consolidation challenges, regulatory boundaries, so it's the development banks which can provide the necessary long-term and patient capital, and particularly the credit enhancement products which can mobilize private funds, and I have just mentioned a couple of instruments here which are important in this area. And also one important aspect, it has been mentioned already, project selection. Project selection is key, and also project definition. How do you define a project is key for getting the developmental, the social, environmental impacts that you want to have. And this is not trivial. And it has mentioned also this morning that projects are chosen arbitrarily sometimes. And I think that through development banks, we can contribute to a better or to a good project selection and project definition, also in the sense of getting the most out of it in terms of developmental effects. So the environmental social governance standards, the so-called safeguards of the international development banks, can have a decisive effect for the quality of infrastructure projects. Now, when we look at different sources, we have to take into account that, of course, the private capital can be more expensive in a way in terms of interest and also risk margins that are calculated than the public funding. ODA grants is, of course, the cheapest way of financing infrastructure, and official contributions or official finance, public finance blended, public finance non-commercial, for example, from a public export credit bank, would be the next one of non-commercial, official non-commercial, then bonds, then commercial banks, domestic debt, and the most expensive way of financing infrastructure is through PPPs. Now, this has been done by my friend Matthew Martin, and I don't know exactly what data he has used. We have to ask him. I just take it as an illustration of the fact that the higher cost of private finance has to be taken into account, and of course it can be offset with the higher efficiency that you would get, the cost savings that you would get. I have mentioned them in the beginning. In a project where a private investor is involved, usually you have this whole of life approach that was mentioned before, where you calculate all the costs and maintenance and everything and the returns and the revenue. And this can lead to a more efficient way of project planning and project implementation. So you have to offset higher private costs with efficiency gains, but whether you get the efficiency gains or not is a question which really depends on the context, right? Now, or I skip this one, and I come to the institutional investors as the second source of patient capital. We had the development banks, and now the institutional investors sitting on this lots of funds which are looking for yield, and which are looking not only for short-term yield but for long-term returns. And there are now quite a number of processes ongoing under the umbrella of the G20 to engage institutional investors, to improve framework conditions, to improve regulatory conditions. And you see here as one of the impediments, regulation, European Solvency II rules. This is an issue for pension funds, for example, how much they can invest in so-called alternative investments. Because when it comes to infrastructure in developing countries, these are so-called alternative investments. It's close to the junk risk category. They are high risk, and that's why, as a normal citizen in the European Union, you cannot buy shares of an infrastructure fund for Africa for consumer protection reasons. You have to buy it through Luxembourg, right? I mean, it's also part of the European Union. But in Germany, I cannot buy it. I have to go through, or my bank has to buy it in Luxembourg, because this is. And for good reasons, pension funds are not allowed by the regulators to have this kind of investments in their portfolio for more than, let's say, 1, 2, 3% of their portfolio. So there are limitations, and for good reasons. So these are the major impediments for institutional investors, but we are on the way, on a good way, to establish reporting standards, performance measurement, benchmarking, which is important for investors who need, for their investment, a definition of an asset class. And infrastructure investment is an asset class which is only slowly being built. And for all this, for being regarded as an asset class, these standards, benchmarking, everything has to be developed, and we are on the way to that. So I would say in 5 years from now, infrastructure, and including green infrastructure and infrastructure in developing countries, will be established as an asset class, and then we can expect more investments by pension funds, other institutional investors in this area. So last slide, and with this I stop. 4 major issues also to overcome the coordination failure that we still have on the international level. Development banks have to do much more to help countries to develop their local capital markets. In the past, development banks very often preferred the disbursements of their own loans to developing countries, even taking into account the currency mismatch, which is always bad for infrastructure investments. They didn't have enough incentives to help countries develop their own bond markets, which are the prime instrument, local bond markets, the prime instrument for infrastructure investment. We have to close the funding gap for project development. We have seen that project development funds have been addressed by multilateral development banks, by the G20. We are still not there. There is a knowledge gap. I have mentioned the data benchmarking, monitoring issues. OECD is working on that. There's a working group at the OECD which is helping to close this knowledge gap on infrastructure, to make it an asset class for long-term investors. And we need much more collaboration between the multilateral development banks. And I have mentioned just a number of examples here. The latest one is the World Bank's Global Infrastructure Facility, which has been announced just a couple of months ago as a new platform where multilateral development banks would cooperate. Why is this so important? In the area of infrastructure investment, we need pooled facilities where institutional investors can invest in. They would not invest in one infrastructure project. The risk is too high. We have to pool risks, and risk pooling is possible only when you have big chunks of capital, of finance that we have in the private arena with all the investment funds, but in the public arena with infrastructure we don't have it yet, but we are on the way to that. So thank you very much for your patience.
I'm a bit concerned about time, so let's give the floor right away to Nikos Mantzoufas to talk about PPPs. But let us try, it's Mr. Mantzoufas, then Plutarchos Sakelaris, Spiros Pangratis, and Vicky Kefalas. But just if a point has been covered, please move on. And let's try and be as concise as possible. And I'm afraid I will have to stop you because we have to close by 4:30 or 4:45 at most. Nico.
Yes, thank you very much. Okay, thank you very much again. First of all, let me start by saying, I will present it in more details at the end, that in Greece, after a long time, we actually have an exemplary project blending public finance with private finance, and this is really an exemplary project because it was involved EU grants, EIB, private funding, and all this combined on a financing that was for the first time used at European level. I'll give you some more details at the end. Yes, please. Now, many of the slides I have presented are already covered. It's quite obvious why we do need infrastructure regarding economic infrastructure and social infrastructure. And we do need them because we provide through them also economic growth, social impact, and sustainable and environmental impact at the same time. So infrastructure is a key element of an economy. It's already said, the investment needs are projected to be around 60 trillion euro over the next couple of years. So there is a big investment need there. And annually, what is being spent is about 2.7 trillion per year, while the need is around 3.7 trillion a year. So you can see that the gap is there. It's already said. So the infrastructure requirements are huge, and at the same time, the government's fiscal budgets are increasingly constrained. Let's separate two things. We do speak about financing, but we need also to speak about funding. And the basic difference is that you can get the financing if only you have the institution there and the funding there. And when I refer to the funding, there are two key elements of the funding: the tax revenues and the revenues from user charges. These are the two elements that can actually boost and attract the financing. So key elements for attracting financing is to have a strong underlying business case, to have good projects, supported by a strong financial and contractual structure, of course to have the institution and the policies in place, and to have also right sustainable funding sources. So these are the two elements, users and taxpayers, that contribute to the development of infrastructure. Now, behind that, there is another argument, another issue is which procurement use you will actually follow. Of course, you all understand that there are several different procurement routes that could follow, the traditional public procurement route, and one on the other side, the privatization route, but also the public-private partnership route. The basic element that I would like to stress is that any of the routes you might follow, what is very, very crucial and critical, it has been said before, is not to leave outside the maintenance element. Because we are talking about investment needs, but we are not talking about maintenance needs. And politicians, in many cases, prefer, when they have to spend a budget, to spend it on greenfield projects rather than maintaining already assets that have been built. So we tend to overinvest in new projects, leaving the maintenance element outside. And in my view, this is one of the key points where PPPs make a good difference if they are followed on the right way. So the whole life cycle approach is fundamental, and public-private partnerships can play a critical role in that field. But beside the whole life approach, another important element about public-private partnerships is that, again, in my view, lead to a better selection of projects. Again, it was said, we need to avoid the white elephants, we need to avoid non-useful projects, and this is not obvious. In many cases, the decisions are not being made as they should be, and they are being led by different lobbies or stakeholders that lead to a direction. It's public financing, so no one actually cares. So in many cases, we end up in useless and white elephant projects. And in Greece, we have quite a lot of them. So in my view, again, it could be that PPPs play a key role in improving the selection process, and of course, accelerating the delivery, and as I said, the whole life cost, which is fundamental. But it's not a panacea. So you need to have the right institutional framework. You need to have all the enablers there so to make this work and happen. Now, regarding the financing, there are several, as I said before, ways for financing, one of which is the project finance. In 2013, to give you some numbers, we had around 280 billion euro as project finance volume. So 280 billion euro was financed of the infrastructure as public finance. And previously, we said the current expenditure is about 2.7 trillion. So it's about 10% that is being financed through a project finance of the infrastructure developments in the world. And another instrument for project finance is also project bonds. Heavily, the financing was relied on banks. We are seeing lately that the banks are pulling out, actually they are not pulling out, but it's become tougher for them to get into these long-term financings. So capital markets and project bonds could be a quite useful solution for the implementation of this type of projects. In the slide again, you can see the number of deals and the amount. It's 280 billion euro that was financed in 2013. And the bigger lenders are no longer the European banks. It's the Asian and Australian institutions that are using this type of structures. The European banks are pulling out. And this is something that we need to consider and take some actions. And again, project bonds, because of the fact that the European banks are getting out of the market, can become a very important and useful instrument in that direction. Now, when we are referring to PPP projects, we are not referring only to concession, user-paid projects, but we are referring also to social infrastructure projects that are being repaid by the public in long term. So the social infrastructure market, and this could cover projects like schools, universities, health, hospitals, social housing, wastewater, governmental buildings, etc. So you can see from this graph that the total amount globally was 13 billion euro. So that's the amount of the market in 2013, and there is an increase in the projects financed through project finance in 2013. At European level, in 2013 there were 80 projects PPP that closed the financing, and the sector that is evolving is the environmental sector. So it's transport, the first sector, and environmental projects, mainly waste and wastewater projects, are the second sector that attracts financing in this type of projects. Healthcare and education follow. And of course, EIB is very, very critical in supporting and financing these projects. Plutarchos, I'm sure, will cover in more details this part. But without EIB, I think at the moment in Europe, we would have less than half of the projects that we currently have. Now, in Greece, EIB always and is continuously keeping their presence and support. We already have 3 availability type of projects, co-financed through EIB, a fire station project and 2 schools projects, and more are to follow. And just to give you 2 examples at global level of 2 projects that recently were financed, again, through the use of development banks. The one is actually the Panama Canal. This was a very huge project of around 5.2 billion euro. This was financed through international finance banks like European Investment Bank, Japan Bank for International Cooperation, etc. And it is to be repaid by the future toll charges. So this is one of the examples, recent examples, of projects that has been financed with 5.2 billion euro. And another example is a bridge in Canada. What is particular in this project is that this is a availability type of project. It does not have revenue, the collection of revenues. It's just the repayment through public budget over the long time of the project. And again, this was a very recent project in Canada which reached financing. Now, let me come to Greece and speak about the exemplary project that I think we have developed and to give you some idea. What we faced in Greece, which is very obvious, is that we were running out of banks and capacity of financing and funding, but I'm speaking about financing at the moment, of the projects. We had a number of projects in the pipeline or with preferred bidders selected that at the end of the day could not close. So what we structured, and this is something that Louka and Plutarchos actually were at the beginning setting this up, was a unique structure using at European level the Jessica Fund. This was something that Louka initiated in Greece when she was minister. And Plutarchos was from EIB the one that signed the agreement. So Jessica is at a European level an instrument that supports and provides financing as loans. What we actually combined is actually this Jessica Fund along with European Investment Bank loans and private investment. And the case study I'm referring to is the Attica Schools project. This is 24 schools where we had the preferred bidder in place and we could not close the financing. So what we did is actually involved EIB and Jessica along with private capital, and the financing closed. And this is a project where 35 million of public funds allocated through the Jessica mechanism, which were EU grants, actually mobilized in total 110 million euro. Again, this is a project that had an ad hoc approval at the DG competition in Brussels. So this is really an exemplary project that for the first time in Europe, we combined EU grants through Jessica loan instrument, EIB and private lending. So this is a project, a very recent project. Actually, we closed and financed and signed these projects in April and May this year. A second type of project that we do have is combining EU grants along with private capital. In the previous model I referred, it was EIB and Jessica acting as lenders along with private investment. Now in the second type of projects that we have initiated is direct grant with no cost and no refund and private investment. Why do we need this combination? Because we need these projects to be operational, and this is very, very fundamental and key. The project I refer to is the transport automatic fare collection system. It's like the Oyster card in London, for those that do know. And again, on this project, we have a preferred bidder in place. And actually, we have this combination with 50% EU grant and 50% private investment. What is interesting in this project is that we have attracted in the procurement process 3 very large international players, Thales, the French Thales, Cubic, and LG, the South Korean company. It was the LG that won the project, and actually they brought also their own bank to finance this project. So again, this is an example of a good structured project that attracted international bidders, also international lenders. Another example is the rural broadband development project. It's the rural broadband system. Again, this is a PPP project where we have achieved to have from DG competition an approval for a state aid at the level of 160 million euro, while we expect investments of more than 200 million euros. Again, this is a project that has been tendered. We have received 3 binding bids, and we are at the final stage of selecting the winning bidders. Again, this is an example of how we used EU grants along with private capital, attracted bidders also on a competitive process. And I'm closing with 2 more slides. Another sector is the waste management project. Again, we are combining EU grants along with private investment and Jessica funding to close the financing. So this is more or less what is the global picture I see and what are some evidence that we see in Greece. This is the approach that we followed so as to close the financing element And this would not have been achieved without EIB in place. And the EIB is very, very supportive in Greece and I think in many other European countries. But what also I need to mention is that this, again, would not have happened if we didn't have the right institutional capacity. And it's very important that all these have been structured on a very comprehensive and a very efficient way. And I think we will have much more results in the near future building on this experience and capacity we have built. Thank you.
Both the data and the analysis, and I hope we will be able to use some of the information you've provided us even in our own report as a kind of report to them. Let us move to, I would say let's hear the 4 presentations and then open it to discussion. We now go to the Plutarchos Sakelaris, who was at EIB, and to give us his view on blending and the potential for blending grants and finance.
Okay, thank you, Louka. I want to really thank you for including me in this high-level meeting and really stress that everything that I've heard from the beginning till now has been music to my ears, and I can assure you that were we holding this in Luxembourg and talking to EIB staff, we would be preaching to the choir. I talked a little bit earlier about the issue of pooling finance. And now I want to talk a little bit more about the issue of pushing finance, and this is through discussing how to blend grants together with financial resources. So the way that I can put it conceptually, when you want to finance infrastructure investment, you basically have to put together possibly 3 different, very diverse, very different group of financial holders. On the one side, you have the official sector. And the official sector, through its taxation capacity, has official development assistance, all these things that we are used to talking about, ODA. Then a second agent involved, a player involved in infrastructure finance, of course, are the development finance institutions, the multilateral development banks, investment banks like EIB that are in development. And the third agent, of course, is the one that we all want more and more to be entering into this field of infrastructure financing, which is the private sector. And there I include, of course, equity investors, funds, long-term investors like pension funds, insurance funds, and so on, but also, of course, banks, both international, but even most importantly, I would say, local banks. Now, what's happening there is that you have a mosaic which is extremely difficult to piece together because these different groups of agents have, to start with, very different risk-bearing capacity and also different risk-return or risk-reward trade-off profiles. Just to speak only about, let's say, the risk-bearing capacity, you have the official sector that has very high risk-bearing capacity. Then you have the DFIs, multilateral development banks, IFIs that have, on the medium side, risk-bearing capacity. And then I would put the private sector on a lower risk-bearing capacity. And the challenge of putting together infrastructure finance, especially of the project finance type, is to mix and match in a way that they will just fall together and they will make the project happen. And this is the issue of pushing finance. And this is where I think the issue of blending grants and finance comes in terms of changing the mosaic so that the different pieces actually fall together. Now, blending is a combination of grant resources together with loans, and it's not something new. For example, if we are only talking about the European Union, there are many different instruments and facilities, just to mention a few. The EU-Africa Infrastructure Trust Fund, mentioned earlier, established in 2007, on which I will expand further later on because I have a special love and interest in that. But also the neighborhood investment facility, several facilities that are modeled after that for Central Asia, Latin America, Asia, Caribbean, and the Pacific, and also the Western Balkans investment framework. Blending in itself, therefore, is not something new. I think the acceptance of blending is relatively newer, and we're still working on it. I would say blending has been a big, how shall I say, fashion word, at least among our circles, maybe for 5 years, but blending is not so new. And I would say the first 3 modalities of support from blending are probably the more traditional ones, and these include investment grants, interest rate subsidies, and technical assistance. What I think is newer, and I would say even more exciting in the field of blending, though, is the next 2 categories, which is blending using ODA instead as risk capital, either equity or quasi-equity, or using it to provide guarantee mechanisms or risk-sharing mechanisms. And that's because these are even more potent, I think, in mobilizing investments. They're even more potent in bringing in the 3 agents that I talked about earlier, and in particular, the private sector. Now, let me talk a little bit about EU Africa Infrastructure Trust Fund, and then I will talk as a practitioner of development finance and give you actual examples of how this blending, especially of the last 2 types, has been used in Africa to actually make projects happen. So the objective of this trust fund is to promote the European Union partnership with Africa through targeted funding aimed at mostly regional, but more recently also national projects. The projects can, certainly if a project is trans-border, it's totally eligible for that, but even national projects that have a demonstrable regional impact or they belong to the Sustainable Energy for All initiative. I remind you, this is the initiative that Ban Ki-moon launched in September of 2011. Those are eligible projects. So we have a little bit of a narrower eligibility. And the sectors are pretty broad, though not all-inclusive. Energy, transport, water, and information technology can be part of that. Let me give you 2 very recent examples, let's say hot off the press, even though in the sense that they have been signed very recently, even though I can tell you that these have been worked on at least since 2010 when I was still at the European Investment Bank. I start with, well actually, both examples will be in East Africa. It shows you my love for that part of the world. And the first one is the Lake Turkana wind power project. Lake Turkana is a very long, very beautiful and very important lake in Kenya, just edging a little bit into Ethiopia in the border. And here we had a project which was very difficult from the start. It's wind powered. It says 300 megawatt, very big for a PPP in Africa. Total project cost estimated at about 620 million. So after all of these issues of having to go through the pool side, so resolving the appropriate regulatory issues and having the appropriate institutions in order to make this happen, there was, of course, the team effort in putting together the financing. And as you will see here from the final outcome, several actors were involved. But there was one very important missing part. There was a missing part in the equity side. So the long-term financiers were found, the equity financiers were found, but there was 25 million out of the 620. Now, I remind you, equity takes about 30% usually of the total project cost. And here's where the amazing capacity of the EU Africa Infrastructure Trust Fund came in. by providing this 25 million euros in the form of a preferred equity share and plugging in that hole on the equity part. So thus bringing in together EIB as the biggest long-term lender, the African Development Bank, various European development financial institutions, these are the EDFIs there, but also, of course, institutional investors investing on the equity side. So if you were to very blindly talk about, okay, what's the bang for the buck, which is usually called the leverage, though of course this is not always accurate, one could say that 25 million made a project happen of 620 million, even though of course I'm not going to argue that there might not have been other ways to make it. So here's one innovative use of blending from this particular facility. Let me give you another example, which is also one of my favorite examples, and this one is because it's part of the Sustainable Energy for All initiative. It involves small-scale renewable energy investments. It involves access to energy. We were told earlier about, I think, Tanzania. I heard about what is the access to energy in Tanzania, but it's not just there. But anyways, given that this is mostly operating in Eastern Africa, it does involve Tanzania, which is projects that actually make small-scale investment projects that can be performing outside of the grid. You know that with renewable energy, the big thing is the grid. Well, these small-scale projects can be outside of the grid, so they can be placed in small, remote communities. So the task there was to bring together the private sector, the local banks, and all sorts of other finances to make them together. And it turned out that it was impossible to make it happen without some extra energy. What were some of the issues there? First, on the bank's side, the local bank side, they had problems, technical problems assessing these. They didn't know how to assess the financial and economic side of these projects. We had the same, there were the same problems also on the developer side. Many times the developers also didn't have the technical capacity to produce economic and technical plans. And this is where the traditional part of technical assistance of 3 million came in as technical assistance to develop that capacity, to build that capacity both for the local banks and for the local developers. But then there was still a problem. The problem was on the balance sheet, the risk-bearing capacity of these local banks. Because these projects continued to be risky, the local banks did not have exactly the risk-bearing capacity to finance them. And that's where the EIB stepped in with a partial risk guarantee. So this is risk sharing, basically. This is the way to help them, you know, and sharing their risk-bearing and improve their risk-bearing capacity. And so the EIB is providing in this energy facility a partial risk guarantee. It can be around 50%, or it can be higher as the project progresses. It's comprehensive, so it's first demand. But even the EIB, because this is considered equity type risk, has some need of taking some load off its shoulders and basically taking some risk of its shoulders. And this is where the EU Africa Infrastructure Trust Fund came in handy, because by providing a 5 million euros first loss piece, it obviously will reduce enough the EIB risk so that the EIB can take that risk. So with my calculations, that 5 million, if you take the debt that it will allow to be issued and also the equity with it, can be used to basically leverage up to 70 or 80 million euros of small-scale projects. So you can see ratios of 15 to 1. So these two examples, I can tell you that I'm extremely much a supporter of this. And just to echo something that Louka and Nikos said earlier, that this development finance instruments and ideas are absolutely applicable to economies in crisis, and especially in fiscal and banking crisis, such as ours, such as Portugal and others, and also to look back, these are also instruments that we very much pushed to get implemented here in Greece, and now they're being implemented elsewhere too. Thank you.
Thank you very much. Let us see now from the bank side and the local bank side maybe, and hear what might be some of the factors and obstacles and constraints that need to be overcome. Thank you very much so far for wonderful presentations. Spiros Pangratis.
Thank you very much. It's an extreme honor to be here in such a high-level meeting. Many thanks to Professor Katseli for inviting me to just give a brief testimony of my days by her side, working at the Ministry of Development, Economy, Development and Shipping. When back in 2010, I have to say, why not saying it, Louka was initiating a transformative agenda for Greece. Of course, the times were extremely hard and very hard to implement all these ideas that were flashing around, and from people, in particular Professor Sagilaris, who had a lot of support, but the general environment was really adverse. At the time, we were trying to create new financing instruments to channel resources to the missing middle, and also to support infrastructure projects. And at the end, we concluded and proceeded with blended instruments and revolving financing facilities, meaning facilities that you get some structural funding, and then that can be sort of recycled and at the end become national resources. And we worked, as I said, with Professor Sagilaris in a number of deals. Louka signed a number of them. One lesson I personally took from that experience was that incentives to intermediation matter. So what are the real incentives within the banking sector in channeling valuable financial resources to the real economy matter. The recipe so far is for development financing, especially to SMEs, being sort of directed to the real economy, especially through the local banking infrastructure, through the local banks. In some instances, Turkey, for example, that may work very well. In some others, Greece, for example, may be not such a good idea. And let me be a little bit radical on that, because at the moment we have the elephant in the room. Greece has experienced a national catastrophe. 25% of GDP was lost. And in addition, we have a huge problem of non-performing loans sitting within the banks. Official estimates are north of 30%. So if you have such debt overhang problem in the economy, then you would possibly expect too much and ask too much from the local banking sector, the big four banks, both tidying up their balance sheets, serving their shareholder interests, and in addition playing a development role. So here I just want to make this comment and we have the experience of Jeremy. Jeremy is the other acronym of Jessica. I don't know which one of you thinks that Jeremy is a success story. I am sort of more reserved on that. I get anecdotal evidence from my students at the university, from graduate students who work for the banks departments, and they say Jeremy is going to the wrong people. He's going to people with a lot of deposits, which the risk sharing, even the 50% risk sharing with the bank, does not work, because the bank at this particular moment in time wants 100% safety in order to give out a loan. So at the moment, in such an environment, with such a huge debt overhang problem, with non-performing loans north of 30%, expecting banks accepting any risk sharing is sort of, I would say, a little bit of not so realistic, right? So going back to, I mean, many of the speakers touched upon these issues. Also, Dr. Wolf mentioned that sometimes possibly, and actually let me interpret it that way, asking a commercial bank to play a role of a development bank may not be that efficient. So, because you have the Basel Committee asking for capital requirements for commercial banks, we've heard Professor Zanias saying at the beginning that Basel is too harsh with infrastructure loans, with long-term loans. So what's the solution? Definitely, somehow, we should bypass the incentives banks have not to direct resources where is needed. A solution being a development bank, sort of working side by side with the EIB, locally based. We have a new development fund for Greece. Unfortunately, is established, is located now, is based in Luxembourg. I don't see that as a vote of confidence to the Greek economy in 2014. So we should think more carefully, not taking for granted that incentives of banks to serve their shareholders are necessarily aligned with the incentive to serve the economy. Thanks.
Thank you for this word of caution, and that will come back to the discussion. And I have our last speaker, Vicky Kefalas from the private sector, kind of giving her own experiences and comments. Vicky, yes, absolutely. Jeremy was the other program. Jessica was one. Jeremy was for financing SMEs particularly. Which one? It's on the right.
Εδώ πέρα.
Okay, great. Now I see my name. Good afternoon, everybody. Kalispera. In turn, I wish to thank Professor Katseli for including me in this distinguished panel. It's my pleasure to be here. I know we're running out of time. I'm the last person to speak. I only have 6 slides, and the good thing is that due to the very perceptive presentations, most of the things I've put in my presentation are in the same note. I'll try not to tire you repeating things. I think the point that more and better infrastructure is needed to support sustained economic growth has been proven irrefutably. To mobilize the necessary funding, a renewed approach is needed. A renewed commitment from governments, from policymakers. As Professor Sakellari said, without the policies, there is no financing. You need to have both together. You need the collaboration with the financiers that Professor Pagratis hinted upon before. And of course, you need to understand the private sector investors. You need to understand how to bring on board the pension funds and the private investor classes that are not currently investing in infrastructure projects. This can happen through a number of things. First of all, creating a viable and credible project pipeline. Not a standalone project, but a credible pipeline. I think Nikos also emphasized this point, to have projects that are well structured in different sectors, to select them appropriately, and of course to have together with that the sound and coherent policies from the governments and from the EU to create the hospitable regulatory environment for investment. And this can happen, of course, through using aid, through using grants, through using other support and risk mitigating instruments, and doing what you can to mobilize all the available sources of finance. My own experience has been to work for the private sector, for developer and contractor companies, bidding and raising funding for infrastructure projects. So this is the perspective I'm speaking from today. Although, as Dr. Wolf, I think, included a slide in his presentations that PPPs are one of the most expensive ways to fund a project, PPPs have irrefutably been a successful and widely implemented procurement model, and a lot of projects have been delivered through this model, and a lot of services are being provided through it. It is a good way to draw financing from the private sector, given the right conditions and the right tendering and procurement avenues. I think we've seen the key challenges that are faced, especially when we try to draw private sector funding into PPP projects. These projects are usually large, and they have a short construction term, and all the money needs to be put up in the beginning. So a lot of times this hints for support, for mechanisms to support the projects during construction rather than after, rather in the operational phase. All the projects have long-term horizons, 20, 30 years, which of course may not always align well with how long financing is available for, how an investor perceives their time of exit, and of course the long term in itself dictates the need for a hospitable political and regulatory environment where the investor can calculate his risk throughout the term of the investment. Irrefutably, these projects have a very complex risk profile. Doing a project in a specific country, doing a specific project might have technical issues, and a lot of times we have quite a bit of interdependence between projects. Projects are not independent. When you build a pipeline, it will rely on its prior connections, on where it's going afterward, on the port interface. So it's not the standalone risk of the project. It's usually much more complex. And of course, when you're talking about seeking private sector investors, you need to take into account that they need to recover their capital, and they need to have some returns. And usually they seek stable and high yield returns. I think the point was made by also the other speakers. Given all these challenges, the projects that are seeking to attract private sector investment funding, you need to have the cooperation with the multilaterals, with the DFIs, with the ECAs, and of course, the governments need to make a new commitment to address these challenges in order to leverage successfully long-term capital for the projects. I will take only a few minutes to expand on 3 points already discussed in the meeting, in the various presentations, only to underscore their importance and potential in leveraging private sector funding. Firstly, I'd like to go over the point of better cooperation between the main stakeholders of infrastructure projects, between the developers, the financiers, the local governments, the multilaterals, the DFIs, the ECAs. This is now more than ever true and necessary, not only for the large-scale, more complex infrastructure projects, but because projects are now being tendered under very challenging economic, social, and market conditions. And this is not the case just for the developing low-income countries. In Europe, most of the EU countries are under austerity measures, the governments are driven by deficit reductions, and the banks are under new regulations, and most of them are repairing their balance sheets. I think also a point to make related to the cooperation of the different agents relates to a point that Nikos made earlier about the revenue from user charges for projects that have fees and tolls as a source of funding for PPPs. I think it should be highlighted that the interests and limitations of the people today as end users of infrastructure projects should be taken into account. as people under distressed economic conditions have limited tolerance and reduced actual ability to pay a share of the cost of infrastructure. This, taken together with the recovery and return expectations of the private sector, only dictates more non-recoverable funding, aid, grants, this type of assistance. This is necessary in order to have socially acceptable and open to use by all infrastructure projects. Professor Katseli, you emphasized earlier that infrastructure is an enabler. Infrastructure should be enabling and should be open to use and not contributing to any disparities. I think getting all the parties to collaborate will not only help create balanced and commercially attractive projects, but also economically and socially sensible for the public projects. I think also another result of the stakeholder cooperation can be a standardized transaction structure and risk allocation. This is already in existence in the UK, but it does not exist for the whole of Europe and, of course, for most parts of the world. I think that, as Professor Sakelaris noted earlier, you need the right enabling framework before you can get projects funded. Such an effort, having a standardized transaction structure and risk allocation, would help towards establishing investing in infrastructure as a particular asset class.
Thank you very much indeed. Well, this was extremely, I think, very, very insightful and complementary, actually, presentations. Let me have for a couple of questions, comments. Yes, please.
Hi, this is Spourdalakis. Can you hear me? It's okay.
Yes.
Okay. So my question is, you are developing the 5th paper, okay? After the crisis, all the papers in the European Union Commission, but also regulations, recommendations, decisions, and so on, start from the lessons learned from the crisis. So, will you incorporate these lessons? I heard one from Dr. Wolf, Solvency II. It's a directive that is brilliant. It's an infrastructure, in fact. But there is a better one, Basel III, which is based on the G20 recommendations, as you told before, Dr. Wolf. So, will you incorporate these lessons? What is Basel? It's an infrastructure. It is financial, but non-financial as well. It is based on what? Policies. It maximizes the benefits of financing. So we have good, great papers in this field. We have experience, and we could incorporate these lessons learned from the crisis and the results in line with the G20 decisions. So, do you have the intention to incorporate this in your new paper? Thank you.
Thank you very much. Other questions, comments? Okay, let me give the floor and
Just in response, I would say that the lessons are many from the financial crisis, but even before the financial crisis, I think that we were seeing the trend. And one of the main things that I think we all should be getting out of this discussion of blending is how can we get, what I said earlier is the most bang for our buck. It's clear that the fiscal space has diminished tremendously. The fiscal capabilities of the whole world have diminished. Where they used to give ODA of certain percentages, perhaps now they will have to maybe even in some cases reduce it, hopefully not. So the biggest thing that we can do is how can we be more efficient and effective at using those scarce resources, which is the fiscal revenues of these countries. And everything that has been said in this meeting, I think, leads to that direction. More development finance with perhaps the same, given the same amount of money, public money, but especially bringing in the private funds into the play.
well, I think we have to close here. I want to thank you all for this, for being here, for sharing with us your thoughts and ideas. And I will leave you with one thought, that I think one thing that has come indirectly is that you need leadership behind everything, both at the national level and in the international level, to make some of these things happen and put them in the right perspective, have the right policies, mobilize finance, and use it effectively so that we can have an enabling and inclusive transformations. Thank you so much.